Hello, welcome back to class. And today we'll be talking about value-added tax. Value-added tax. And in doing this, we will look at the concept and rationale for VAT, the registration, record keeping, and invoicing requirements, the computation of input and output VAT, VAT exemptions, zero-rated goods and services, and lastly, the remittance and compliance under the VAT Act. VAT has become one of the most important sources of indirect tax revenue for the Nigerian government, playing a central role in the country's fiscal system. And it's introduced to replace the sales tax regime, and VAT is designed to tax the value added at each stage of production and distribution, making it broader, more transparent, and more efficient than traditional consumption taxes. And its governing legislations, which is the Value Added Tax Act, outlines a framework for collection, remittance, and administration of VAT across various sectors of the economy. Value-added tax is actually an indirect consumption-based tax on the value added to goods and services at each stage of production and distribution. Key principle of this is the final consumer bears the tax, and businesses act as collection agents for the government. And just like we said, the governing law is the Value Added Tax Act, and the administering authority is the Federal Inland Revenue Service. And the rationale for this is the importance of this is it broadens the tax base. It also provides a stable revenue stream. It's more efficient and transparent than the old sales tax. And lastly, it minimizes the cascading effect, which is tax on tax. And we look at the VAT mechanism, which is the output versus the input tax mechanism, which is the output and the input tax. And when we talk about the output tax, it's actually VAT charged on sales of taxable goods and services, and this is a liability to the government. And to calculate the output tax, it's actually selling price excluding VAT multiplied by VAT rate. And for input tax, it's actually a VAT paid on purchases for business use. And this is a recoverable credit. And to calculate it, it is actually purchase price, which is exclusive of VAT multiplied by VAT rate. And for the net VAT paid, it's actually the difference between the output and the input VAT, which is output minus input VAT. And this is the amount remitted to the FIRS. And looking at the aspect of registration and invoicing. From that, we see that under the registration, it's actually mandatory. It's mandatory for business with an annual turnover exceeding 25 million, and voluntary registration is possible for those below the threshold, and the unique VAT registration number is issued when registration is carried out or is successful. And for tax invoice, it's actually a critical document, and it must be issued for all taxable supplies, and the required contents are the supplier's name, the address, and the PRN, the customer's name and address, the description, quantity, and price of goods and services, the VAT amount charged, and the total amount paid. And it's needed by customers to be able to claim their own input VAT. And looking at the record keeping for VAT compliance, The purpose is to ensure accurate computation and support claims during FIRS audits. And what to keep to be able to do this, the first is all tax invoices issued and received. And another is the import and export documentation. Another is accounting record, which talks about the ledger, the cash flow. And lastly, the VAT return and payment receipts. And for the retention period, its record must be kept for a minimum of 6 years. And the consequences of poor record keeping is an inability to claim impute VAT, leading to a higher tax cost, potential penalty. We have VAT categorized into zero rated supplies, and we also have VAT exempt supplies. And when we talk about the zero rated supplies, it's actually VAT rate, that's a VAT rate of 0%, and it means that there is no output VAT, no output VAT is charged to the customer. But the supplier can recover all input VAT paid on related expenses. An example of this is the exported goods and services, non-oil exports, essential food items like grains, additives, and pharmaceutical products. And the impact of it is that it makes Nigerian exports competitive, and essential goods affordable. The next is a VAT exempt supply, and under this, the VAT rate is not applicable. And what it means is that no output VAT is charged to the customer, and the supplier cannot recover input VAT paid on related expenses. Example of this is medical and the hospital services. We also have the educational services, residential rent, financial services. And it's very important to note that input VAT becomes a business cost, potentially increasing the price of these services. We have a comparison for zero related, the output VAT is 0%, while for VAT exempt is none. For input VAT recovery, under zero rated is fully recovery, and for VAT exempt it is not recoverable. And for impact on business, for zero rated it's neutral, no VAT cost, while for VAT exempt it's increased cost. And lastly, for VAT return, under zero rated it's reported, while on VAT exempt it's not reported. And zero rated is inside the VAT system with a zero rate. Exempt is outside the VAT system entirely. And then in computation, in a scenario whereby the taxable sales is 1 million and purchases for taxable sales is 400,000 and VAT rate is 7.5. And to calculate the output, but it's actually the sales, which is 1 million multiplied by 7.5, which is 75,000 naira. And for input VAT, that's 100 multiplied by 4.5%, I mean 7.5%, which is 30,000 naira. To calculate the VAT payable now, it is 75,000 minus 30,000 naira, which is 45,000 naira. And the company remits 45,000 naira to the FIRS. In terms of remittance and compliance, for filing VAT return, it is done monthly, and it has a deadline of 21st day of the following month. And payment of VAT, the net VAT payable must be remitted to the FIRS by the filing deadline, and it has consequences also if not complied with. The first is penalty for late filing and payment, interest on overdue tax, and legal actions and prosecution for severe evasion. In conclusion, VAT is a multi-stage indirect tax on consumption, And the core calculation is output VAT minus input VAT, which is equal to the net VAT payable. And the registration is mandatory for businesses above the turnover threshold, which is 25 million naira. And zero rated and exempt supplies are fundamentally different. The ability to recover input VAT is the key distinction. And compliance requires accurate invoicing. It requires accurate invoicing, diligent recording, record keeping, and timely monthly remittances. Thank you.